Welcome back to America's Commercial Real Estate Show. I'm Michael Ball. This segment is brought to you by buildout.com. If you're a commercial agent, check out buildout.com. You'll be glad you did. Well, today we're talking about multifamily. Please welcome my next guest, Larry Souza. Dr. Larry Souza is Managing Director with Capital Brain, and he is on Skype with us. Thanks for joining us today.
You're welcome.
So let's talk multifamily. So what do you see out there? What kind of trends are you seeing in performance?
Sure. Just overall, we're past the peak. You saw rent growth basically peak out in 2015 and 14. You saw cap rates, have basically bottomed out and are flat and slowly rising in some markets, but the cycle and cap rates are at their bottom. So price appreciation is going to have to come from your income component and not cap rate compression. You're seeing occupancy rates have already peaked. They're starting to slow down or starting to come down off their peaks. And you're starting to see the peak in the construction cycle, either in deliveries or permits. Peaked out probably last year. They're slowing, but an interesting trend I'm seeing is just the amount of units that are actually being delayed and being pushed off into the future.
Well, it's interesting to hear because that's always been our problem in the past, right? We overbuild and then we have a problem. So I think this cycle, maybe we're doing it right? Not overbuilding?
I can never say that we ever do it right. I mean, the profit motive is too strong, but if you go back historically over the last 10, 20, 30 years, the amplitude in the cycles, have been smaller and less violent as they were in the 70s and the 80s in particular. But this is the largest construction cycle that we've seen probably since the 80s. The 90s was fairly muted, and the 2006-07 was fairly muted too. So this is really the best cycle we've seen. So there will be some supply risk, particularly in those commodity markets like Houston and Austin and Phoenix and those types of markets.
Yeah, well, it's certainly been a hot market, and investors have had a lot of interest in multifamily. I know in our shop here in Atlanta, we just can't get enough product for the buyers out there. So what are you seeing for sales volume around the country right now? Sure.
Well, for in August, if you look at Real Capital Analytics data, RCA data, they reported about 11.7 billion for the month. This is down about 8% from August of 2016 and is down about 18% year over year. So again, all the indicators point to a peak in 15-16 and then a deceleration, not only just exhaustion in sales volume, lack of inventory, another cap rates, at their all-time lows, and pricing at their all-time highs. So that's just a late cycle indicator.
What do you think about rising rates? I know it's been kind of a slow growth. We expect, I guess, a little more slow growth on rising rates. What's the impact on multifamily there?
Sure. Well, multifamily is my favorite product type. I have to disclose that right off the bat. I was 7 years at BRE Properties and really got to learn about the apartment market. And if there's any property sector that I would want to be in compared to the other sectors, and that would be multifamily. One, you have demographics backstopping your demand, particularly on the occupancy side. If we ever do go into a recession, we could always lower rates and fill the occupancy and fill the units in the communities up, which I really like. And then the dirty little secret is that we have access in the apartment sector to Fannie and Freddie financing. And the collateral has always been better. The tenant credit risk has been better. The product quality has been better. And with the government-sponsored entities backstopping and providing liquidity and providing a permanent component of the capital stack for these large institutional investors and publicly traded REITs. The fundamentals from both the demand and the financing side have never been better. It becomes a supply issue at some point.
Right. And you're mentioning some of the trends there that are kind of impacting the market. And I think, the multifamily market's had such great growth. I mean, seems like the rental growth and occupancy growth has been so strong it even surprises the folks who are tracking it every quarter for the last several years. Starting to slow down a little bit. What do you think about demand moving forward? What are some of the trends, and aren't these trends changing at all with the millennials getting a little older? Baby boomers getting a little older. What do you expect trend-wise moving forward impact on multifamily?
Sure. I mean, if you look at, I just looked at these statistics. This was from the Marcus and Millichap report that those households under 35 years old, 66% are renters. This is the highest renter population, both on a percentage basis and on a total basis. Total renters in that age cohort is about 43 million people. This is the highest it's been since 1985. So just the demographic fundamentals, and then you couple in student debt, lack of the ability to get a down payment, to buy a house, home prices that have appreciated significantly, and just overall housing affordability. They're pretty much trapped into the rental space. And then from an economic standpoint, I've always been a big proponent of investing in apartment buildings and communities in and around what are called growth poles in urban economics, which is hospitals, airports, urban CBDs, transit centers, universities. You can pretty much backstop your economic occupancy if you can get close enough to those economic centers and really create a great investment opportunity from a risk-adjusted standpoint.
Yeah, those are very good points. And so what are some of the hot markets out there that you think may have some potential revenue growth, some rent growth coming in?
Sure. And again, you're testing me again because I'm a supply constrained. I'm not a big commodity market player. I like markets that are supply constrained, particularly at the sub-market level, coastal. I know the cap rates are low and prices are high, but again, those markets always have the best fundamentals. But if you look at markets that have actually shown rent growth, recently they were late in the cycle. They were the hardest hit by the housing crisis, particularly Sacramento and Las Vegas and Atlanta and Dallas. Those are showing some of the best rent growth right now because they're so late in the construction cycle. Plus, they have very solid job growth. I'm not recommending them. Again, I'm not a commodity market person. I'm a supply constrained market person. I like certain submarkets like Washington County up by Intel and Portland if I have to go there. Downtown Seattle. I like Bellevue, particularly from a tech standpoint in the Bay Area. I mean, if you can get into San Jose, if you can get into San Francisco, there might be a play out in the 580, 680. If you go down to LA is a whole different, they got 13, 22 different submarkets down there. So you can pick, but there's some opportunistic opportunities down in Southern California. And then if you want to play more commodity-based markets, you can go to Scottsdale. You can go to Salt Lake. Salt Lake's performing very well right now. Again, not a lot of supply. And then as you go further east, you really start moving into commodity markets. And I think you really need to be strategic in where you place your capital and make sure that they're next to economic centers to stop the economic occupancy.
And have some of those markets or some other markets kind of peaked out of their performance?
Yeah, you're starting to see it as the supply starts to come online. And actually, job growth overall has started to slow. And I think more of it's just, if you believe in the unemployment rate numbers, we're beyond full employment, and companies are having a hard time actually attracting new talent. So you're seeing pretty much job growth starting to slow all across the board. The question will be, what will the housing crisis, along with constraints in the labor markets, do to GDP growth rate going forward over the next few quarters, along with rising interest rates, which we've seen happen on the short end of the yield curve. And the long end of the curve has started to come down, but it's up. And my biggest concern is that gap between short and long-term interest rates are starting to narrow. And if the Fed doesn't watch it and they oversell their balance sheet, we may see an inverted curve and we'll be in a recession in 24 months.
So what would be your parting tip, Larry, for people in the multifamily world?
Pick your submarkets, pick your assets, pick your partners, do your due diligence. Cap rate compression is over. You may have to pay up if you're coming out of a 1031 exchange. So, maybe do a reverse exchange instead of a straight exchange to give yourself some time if you can do it. And then pick your partner, pick the collateral, get into bed with a good lending partner, and really underwrite the economic occupancy and the rent growth, and try to be conservative at such a late stage in the cycle.
All excellent tips, Larry. As usual, great information. Thanks for joining us.
Anytime. Thank you.
And if you'd like more information, his website is capitalbrain.co, so capitalbrain.o. And stay tuned. We'll have more on the U.S. multifamily market. I'm Michael Bull. This is America's Commercial Real Estate Show.